Okay, this is a typical REIT InvIT structure. And just for context, maybe 30-second background, you have the REIT right at the center. You have the sponsor and the investors as unit holders. You have an investment manager, which basically takes care of everything day to day with respect to the REIT/InvIT. You have the trustee, which is the legal and beneficial owner of all the assets that are held by the REIT or InvIT. And finally, you have the SPVs, which will have the relevant projects, which have a real estate infrastructure. The SPVs will be housing these projects.
And do it that side. Yeah.
Okay. I can't see the slide. I hope everybody else can see the slide. So the first question, the most often asked questions nowadays, of them, the first one is, can a private InvIT invest in, let's say, a greenfield PPP project? Now, the short answer is no, because every private InvIT is mandated to invest only in a certain kind of infrastructure project, which basically means the infrastructure project should have at least invested or spent 50% of its capital cost, or the project must be at least 50% constructed. If yes, you roll it over into the InvIT, otherwise you don't. Now, is there a workaround for this? Here's how we've looked at it. Step one is we take the SPV and we have the investors of the InvIT invest, let's say, a small portion of money as equity directly into the SPV. Let's say it's a 70-30 project, you have 30% equity, 5% of it comes directly from these investors and it sits in the SPV as equity. The rest of the money comes directly into the InvIT. This is the second step where the same investors put money into the InvIT. The InvIT uses this money, routes it back to the SPV as sub-debt. So you have the SPV now holding equity, having equity from these investors, and the InvIT having put sub-debt for the equity portion. And the last one, of course, is the last step is when you have the 50% construction completed, you roll over the SPV into the InvIT. And with that, you have a clean structure. The InvIT owns the SPV. The investors have swapped their units from the existing equity that they had in the SPV. And you achieve basically what you wanted to achieve on day one. Now, is this something fairly simple? Is this something doable? Are there any catches? Yes, two main catch points here. One is, can an InvIT invest how much ever sub-debt it wants into, let's say, an SPV which is sitting outside of its structure? The answer is no. It has to be less than 20% of the overall InvIT value, because the prescription is at least 80% of the value that the InvIT has should be in the infrastructure projects that it's housing. This SPV, obviously, to begin with, is housed outside of the InvIT structure. So you can invest in only up to 20% of the overall InvIT value. Is this a problem for larger InvITs? Not really, even for smaller InvITs, because it depends on the size of the greenfield project, obviously. But in most InvITs, in larger InvITs especially, this may not be a problem because the numbers will add up. It will give you enough headroom to make the investment. Is there any other catch from a commercial perspective? Yes, which is when you typically speak about sub-debt, I think the understanding is the shareholders are the folks who are putting in the money. But in this case, I think the shareholders initially will hold whatever minor equity, but the debt which is coming in is actually coming in through the InvIT, and they are not the ones holding the debt directly. So from a regulatory perspective, if you go speak to a concession authority, they may not easily understand what this sub-debt is. For them, it's a very simple algorithmic approach. You go, you see whether the shareholders have put in the sub-debt as well. If not, ask questions. So there may be some level of discussions, so to speak, and you may have to examine the underlying concession agreement to make sure if there's any debt due that is to be paid out in case of a termination, etc. You're covered well. So some of these aspects will have to be taken care of, but by and large, this is something that can be implemented and that InvITs have started implementing on the greenfield side. So this is the first one. I think the second one, okay, the second question that we've seen is about just when you start setting up an InvIT, the first question which comes to everybody's mind is, how is my pipeline going to grow? And if my pipeline is dependent on the sponsor and the sponsor rolling over assets to me, especially brownfield assets because pure greenfield is not permitted, what is the say that I have in, let's say, a slightly well-dispersed InvIT? What is the say as a unit holder that I have? And how do I make sure that if I don't have a seat at, let's say, the IM, how do I make sure I have a yes or a no in critical decisions like, let's say, a rollover of an asset, the value at which the asset is getting rolled over, so on and so forth. So maybe I'll rope in my colleague Rena to discuss this very quickly. But Rena, what do you see as typical questions that come up from, let's say, investors who want to take significant minority positions on this?
So maybe I'll divide this into three parts. The first being what the status quo framework looks like. The second part being what the regulatory sort of inclination for it to look like is currently. And the third part being what does the significant minority investor actually do in this sort of scenario. So the status quo position is fairly simple. It's on the screen in the first bullet point. If you want to acquire, if you're rolling over a brownfield asset to the InvIT, which is more than 110% FMV or more than 5% InvIT value, you need unit holder approval, which is fairly straightforward. Digging a little deeper, the law today is quite clear. Related parties to a transaction in an InvIT cannot vote on, for instance, this rollover where you need unit holder approval. The problem now is that there seems to be some sort of regulatory desire or inclination in the market to align this framework with that of the listed equity space. What does that change? That would basically mean that if you're a unit holder who holds above 10% in an InvIT, even say a private listed InvIT, which is pretty much a private InvIT except it's listed for procedural reasons, then you wouldn't be allowed to vote on something like this. Principally, seems completely misaligned because public in a, say, a public listed company versus a public unit holder in a private listed InvIT are hugely different conceptually and principally. In a listed company, of course, the principle is clear, right? It's to protect retail shareholder interests. It's to ensure that you have enough public voting on, say, matters that can be sensitive and material from an RPT perspective. In the context of, say, InvITs, private listed InvITs especially, where you have, which is a sophisticated investment product, you have institutional guys coming in and taking up significant minority stakes, up 20–25%. They're coming in with significant knowledge of what the pipeline looks like, what the risks look like, and what their returns need to look like. In that context, aligning this with the framework of listed equities and sort of comparing a unit holder to a retail shareholder doesn't really make a lot of sense. If you take up any like private listed InvIT right now, it's most likely every institutional guy that comes to us wants to take up a stake which is somewhere plus 15%. So what happens in a situation now where we actually align frameworks because of regulatory, I don't know, inclination to do that? What happens in an InvIT where your sponsor anyway can't vote on something like this, they're sitting out? All of your unit holders are 10% plus. Who votes? How does this even procedurally work? Totally unclear. That's one thing. The second thing is, and I'm sensitive to not saying that this is an amendment that's coming and more of a regulatory sort of feeler out in the market, but we don't know how this change is going to be implemented. If it's implemented in or replicated to align with the public listed equity sort of framework, verbatim, then it's very possible that in a private listed InvIT as well, you won't be able to vote at all, let alone vote to disapprove a matter which requires unit holder approval, which is another dissonance from the listed equity framework. So maybe just coming to the third part of this and how a significant minority unit holder is supposed to react to something like this. And we were talking about this earlier today, and the only sort of response that I can think of is that you take up a 10%, sub 10% stake in a private listed InvIT, which seems kind of like really bad advice. Like if you have an institutional guy coming in and telling you they have an InvIT with a decent pipeline, they have decent returns mapped out, and your advice is take up a 9% stake, I don't think that's going to fly with people who are coming into InvITs as a sophisticated investment product. So that's my take. I mean, I'm open to hearing what you guys think.
You have a different view, Anish?
No, I think, I don't know how practically SEBI will be able to implement this going forward basis. I think they need to bring about a comparable, situation, not looking at public markets or publicly listed companies. I don't think so it will work otherwise, especially for unlisted or privately placed listed InvITs.
So if the change that, if I can use the word feeler again, borrow it rather. So if the feeler is to align just the public listed space with, let's say, public listed space itself, which is public listed InvITs, then I suppose to an extent this is fine. Although it would have some of the larger investors set out, but that would be, would that
But
in
then
your view
I
be
think
an
it will
apples
be a
to apples
comparable,
comparison?
yeah, possibly comparing apples to apples, but in a privately placed listed InvIT, this just can't work.
Makes sense. So this was the second theme on the questions that we've been receiving, and the last theme, I suppose, is what's happening probably currently and maybe 2-3 years from now around monetization by InvITs. So we've seen one round of InvITs being set up. Folks are keen to exit from their existing positions. It's so happening that the people who want to exit are also looking at suitors who are InvITs or AIFs. So in that situation, the natural inclination that we've seen is you don't want two InvITs. An InvIT does not want to be acquiring another InvIT, or an AIF does not want to be acquiring an InvIT, etc. What really is the avenue? Is it possible in a situation like that? Is it not possible? That's one theme. Or the second theme is, let's say you have a public listed InvIT, you have a majority investor who wants to exit, similar considerations, because every buyer who's coming in may not be comfortable taking up a significant position again with a public InvIT, or running a public InvIT, have a 25% float, etc. So is there a method by which you can have an exit for these investors, either in a public InvIT or for investors who are existing in an InvIT and looking at a potential InvIT suitor? I suppose the answer again is 2-3 steps maybe. First is you do a valuation of all the assets. You take it to the unit holders after that. It's a fairly straightforward process from here, in that if 50% or more of the unit holders say yes, then you can technically transfer all the InvIT assets which are below the InvIT directly to the purchaser. And more importantly, you don't really see a SEBI approval angle, so to speak, at least in the way it's prescribed right now. So if you look at, let's say, an InvIT takeover, you will also have to do an IM takeover simultaneously with the InvIT. You will have to go to SEBI, discuss with them, so on and so forth. This is a fairly straightforward option, if you look at it that way. And more importantly, this is also an option where all the larger investors can sit in and vote, the 50% part, because you don't have any disqualification, so to speak. Everybody is treated equally. If people want to sell out, everybody has the same option. As long as the buyer is an unconnected party, you go ahead, sit in on the unit holder meeting and make sure you approve it, transfer all the assets. So this is one of the options that we have seen being explored.
Just on that, maybe I want to step in here. There is still a concern from the unit holder's perspective. I mean, we can differentiate the two, but when the InvIT were to sell the underlying SPVs to another buyer, there is a tax that is levied on the InvIT, and it is exempt in the hands of the unit holder. The distributions will eventually get exempt under the, in the hands of the unit holders. But there is a different taxation regime for units versus the, InvIT's own taxation. So InvITs typically being residents will get taxed at 20%, whereas let's say if there are non-resident unit holders, if they were selling their units after having held them for 3 years, which makes it long term, you could have effectively 11%, 10.92%.
And you could also have a potential treaty exemption if
potential treaty exemption
folks are coming in. So yeah, to that extent, there is a question, obviously, if you adopt this route, there's a question naturally of, is this the best return possible for the unit holders? May not be, but I suppose that's where the governance part of it, the management, the proxy management, press management part of it kicks in, because if this is the best bid that has come through, or if this is one of the few bids that comes through without other incidental challenges, and if the IM is able to establish that this is how it's supposed to be done, especially in a public InvIT because unit holders get to benefit from it, that's still manageable and a transaction is still on the cards instead of right at the beginning saying InvIT doesn't want to hold another InvIT, what do we do now? There's no transaction at all. So the transaction is still live. It has its challenges. You have to jump those hoops, but it's something surmountable, so to speak. Are returns affected? Yes, it could be affected. And if it is, to what extent? You compare the different bids that you have, see the challenges, pros and cons of different bids, and then take a calculated call on whether it's fine or not. So that's the third theme that we've looked at, and that's pretty much about it.
So maybe I can take it forward. The biggest change, and budgets have been coming and going, and largely we see most of the budget events are effectively non-events. But one big thing that has happened in this year's budget is around some changes in the taxation regime for REITs and InvITs, largely relating to how monies were actually distributed or paid out from the SPVs to the unit holders, by way of repayment of loans. So what used to happen is typically with SPVs getting stabilized, you have change in the loan to value ratios, and you are able to get higher level of borrowings in the SPVs. Use that money to redeem some of the shareholder debt that is existing between REIT, InvITs and SPVs. And that money was paid out to the unit holders as effectively a repayment of underlying loans, but it was not paid out as redemption of units. Till now, that income or that amount of money that was received by the unit holder was not getting taxed in the hands of the unit holder. And that's what the government wanted to catch up on. They wanted to get this amount which is in the hands of the unit holder taxed. But so what they ended up doing is whenever there's a repayment of debt and that amount is included in the distribution, to the extent it is not out of repayment of units or redemption of units, the entire amount is taxed in the hands of the unit holder as income from other sources. But to the extent there is a redemption of units or repayment of units, your cost base is protected, and to the extent of cost, you are not taxed. So in the example that we have where redemption is 100 and your original cost was 50, only the balance 50 is taxed in the hands of the unit holder if the distribution was made out by way of redemption of units. Now there are certain practical challenges today because there is no concept of par value of units under the SEBI regulation, and therefore if today one were to redeem the units, it has to be entire unit as a whole, and you will not have fractional units to be redeemed. So that's a practical issue, and maybe this SEBI will come out with a regulation or amend the existing regulation to come out with a concept of par value.
In fact, actually, Anish, we don't even have a concept of redemption today other than through buyback, which is also not enabled by SEBI for both REIT and InvIT.
So, like I said, there are several practical challenges that are coming out because of the change in law. But I guess there's already a representation being filed on this, and the government is open to thoughts. The other big change is because it's taxable as income from other sources, most people will get taxed at the highest rate of tax, as against if this was treated as capital gain triggering income, then the tax levels would have been lower, maybe 11% or depending upon how long you've held the units for. So that's another change that we've been asking the government, and hopefully we are seeing some door being opened on that, and let's see how it turns out. Yeah, Ritesh. Yes.
You bought them at 350. So does that mean that tomorrow your unit is different from mine?
That's right. So as of now, the way the language reads is cost of acquisition in the hands of the unit holder and not what InvIT or REIT has, subscription value for.
Yeah.
So that, and you can compare this with the buyback regulations, where buyback taxation is based on what the company has received, as against here they've talked about cost of acquisition in the hands of the unit holder. So you're right. Different people will have different costs, and that's another practical issue, especially when the business trust is actually redeeming units of a non-resident. So in residents case, you don't need to do a withholding, but in case of non-residents, you need to do a withholding, and you don't know what, today there's no mechanism to get that cost. So you actually need to ask your unit holders to to give you a representation that this is my unit cost, and you'll have to effectively rely on that.
Okay. I don't know. I mean, I think there's just too many issues that this has opened up.
Yeah.
If it's actually implemented, Ritesh, then ideally you wouldn't have any withholding if that goes through. And then you will allow each investor to figure out what their cost of acquisition is, come up to their own taxes, and then accordingly decide what they need to do.
Actually, find the unit. Already after the right social principle has been changed, the commercially changed this. Like उसने कम दिया, and then ऊपर से you also you end up paying
I'm not able to get my head around it. I bought this unit for 300 bucks. Over 2 years of holding period, let's say I got 30 rupees as repayment of debt, or 40 rupees as repayment.
Correct.
You're saying my cost is now
260.
Market price is 600. Now.
Yes.
I'm selling it for 600. The guy who's buying it from me, he's going to pay me 600, or he's going to pay me like...
He's going to pay you 600 because that's the market price. He'll buy it for 600. Now his cost of acquisition is 600. Your capital gain will be 6. Yeah, absolutely. So your capital gain is 600 minus 260. Which is, yeah, which is a different aspect. Yeah. So depending on how REITs are doing in the long term, right? Because you're still valuing the future rentals.
I think the question, Ritesh, is if you've bought it at 300 and before you sell it, there's income other than interest and dividend income that you're receiving. What happens to that income? That is going to shave off your cost of acquisition, let us say to a certain extent. If it's redemption, it comes down to 250. If you do end up redeeming the units. And from 250, if you sell it at 600, it's 600 minus 250, not 600 minus 300, which is what the government is trying to plug today, 300 to 250.
No, they have been, so they have not been taxing repayment of deposits. But yeah, what was happening earlier is the cost of acquisition was getting reduced. So internationally, that's the difference. So, when you're selling in the market, effectively, you're in Ritesh's example, 600 minus 250 is what you pay capital gains on. But it was not getting taxed like the way the government is seeking to tax when there is no redemption of units.
I think that's why it's speaking from here, but there has been a major misconception because in people use more countries. I don't think there was ever a big. It was never supposed to be taxed on the person. If at all, it should be reduction of cost of taxes. Never a big.
Sorry, you had a question.
The current context is nothing called principal reduction. It would mean that there's nothing to be reduced from the cost.
Correct.
Currently, because even if I bought it 300, all I'm going to end up doing is just pay whatever, the full tax on the 30, 40,
Yeah.
50, whatever I got as a repayment of debt. And for practical purposes, if ever
Correct.
the reduction was allowed, is where I can.
Yeah. So which is the change that we're asking SEBI to make? So you bring in a concept of par value, and then you can redeem partial value of that effective face value, so to speak. Now, how we understand it in case of shares of company.
But I'm saying this change is not possible. I'm not saying that it should not be. It not otherwise
Yeah.
it becomes a theoretical discussion.
True.
If it's not there, then you redeem only towards the end, if at all you have to. In between, you continue to give back.
Which then
principal.
brings up the whole rate of taxation issue, because income from other sources is always taxed at the highest rate.
And in fact, I mean, going back to your first thing about greenfield, the whole concept of subject doesn't make sense because we're going to be taxed at 40%.
That's
I don't think so the yields are going to make sense.
And also remember one thing, SEBI forces you to distribute this money. It's not that, you know, you cannot reinvest or keep the money in the company. You have to repay this to your unit holder, which is where this feels that it is inappropriate at this stage. And especially because the surrounding regulation today is not, helping. So maybe another point, again, similar thing on sovereign wealth fund, pension fund exemption. So all the sovereign wealth funds and the pension funds get exemption from InvIT, provided they have held the units for at least 3 years. Okay. Now the issue is when you force the business trust to actually do a redemption, you're not holding the units for a period of 3 years. Now they have not thought through about the impact of this, but effectively it means that the sovereign funds, pension funds will not get benefit of this investment, hopefully only in respect of the units that are getting redeemed and not the other investments. Hopefully, again, that's an interpretation, but we'll see how things come about. The last bit that I want to cover, some of the roadblocks that are still there in migration or otherwise. So we still were hoping that the law changes around swap of when SPVs are getting swapped to the InvIT or REIT. Today, only shares of a company are, effectively exempted from or deferral of taxes provided for. There are several investments that are in the form of LLPs, or you will always have CCDs and instruments like that, where a swap of instruments against units is still considered to be taxable. There is again an issue for where Indian companies which are under the old regime, dividends paid out of this entity to the InvIT and upwards to the unit holders is exempt. But if you are under the new regime, which is the 25% effective rate, you end up paying tax in the hands of the unit holder. Unfortunately, once a company opts into the new regime, there's no way back that you can go back to the old regime. So that's something that is still missing in the law. Also around business losses, lots of infrastructure companies today may have substantial losses. When they get swapped into the InvIT, and I'm again forced to have 100% effective transfer, in some sense to the InvIT, or at least the majority holding. And the moment I have majority holding transferred to an InvIT or a REIT, I will have lapse of business losses. So the other bit that is still different, and while we were talking about having parity between listed company shares regime versus listed units regime, there is still a holding period gap of where listed companies get long term in a year. Here we still need to hold the units for 3 years to make them classified as long term. And the other bit is there's still some controversy where when the business trust is acquiring shares of the SPV, what is the cost of acquisition in the hands of the business trust? Our view at least is that whatever you're paying for at the market value, that's the cost of acquisition, and not the value of shares that was in the hands of the sponsor who's transferring the shares into the InvIT. And this is again the example that you were giving. If the InvIT were to sell the SPVs below, then how do you compute the tax? So here, this is something to be kept in mind when you're transiting from InvIT to another structure. Then this cost of acquisition needs to be thought through. This may be last slide. This is again some issue on FPI versus FDI investors. So while interest paid out from the InvIT is taxed at 5%, but FPIs as an investor have a very different regime for their taxation. So there's some controversy on what is the tax rate applicable to an FPI investor versus an FDI investor, who would otherwise, any interest earned by the FDI investor is clearly taxed at 5%. But in respect of an FPI, there's always this question mark whether you'll apply the 5% rate or the 20% rate that is otherwise applicable to FPIs. So there's, this controversy has been lingering around for a while, and there's no solution as of now. Hopefully, to the extent possible, have an FDI investor in your REIT or InvIT as much as possible as against an FPI to avoid this kind of controversy. And the other practical issue that we've seen is, the business trust is required to file, their reports in a manner that, show what is the distribution and show how much income has been earned vis-a-vis each unit holder. And there's always this issue around accrual of income versus actual distributions in the hands of the unit holder. So that's something that one needs to bear in mind. I think we just didn't want to spend more time on this, but I think I'm also done on this. Thank you very much.